and venture capitalist. Jonathan Brereton, CEO, Axion Chicago. Paul Fehrenbacher, President, CEO, and co-founder, Brightseed. Sharon Schneider, co-founder and CEO, Moxie Jean, Upscale Resale. Scott Starbuck, founder and CEO, City Souls. And moderator Linda Derrick, Executive Director, Kellogg Innovation and Entrepreneurship Initiative, Kellogg School of Management.
I'm Sharon Schneider with Moxie G. So we started out with a little bit different business model. It was called Good Karma Clothing for Kids, and it was more like Netflix for baby clothes, where we owned all the clothes and you paid a monthly membership fee and we'd send you 7 outfits at a time. And what we eventually realized was that moms found the idea of us owning the clothes to be stressful. And so we, instead of essentially renting it to them, we had to change our business model and say, what if we just sell it? Which sounds like a simple change, but it actually changed everything, because we went from having one product that was a button on our website that said subscribe, to now we probably have 10,000 unique products for sale on the site, because every outfit has to be photographed and added. We could inch along and grow it incrementally and bootstrap it, and it would take us 4 or 5 years to kind of start to build up a loyal base, be very small. Or we could kind of seek to inject some capital and grow it quickly, because it was really going to take more capital certainly than we had to buy the clothes, to do the marketing, to get the labor, to turn it from raw material into finished product for sale at moxieg.com. So that you have to start with sort of that emotional story, vision that hooks them and makes them say, I'll invest in this company. But then you do have to back it up with, the numbers and the metrics and the story of data to show that they're making a good decision.
Scott Starbuck, CEO and founder of City Souls and CitySouls.com. We went out in 2010 and when things were really down and dirty and we'd had a tough time, and said, I'm gonna scale this .com company. So we went out and launched CitySouls.com in December of 2010. We did like $2,000 online, like woohoo! 2012, we launched City Souls TV, our video blog. Really paid attention to the traffic to the site, the conversion rates, the customer experience. We tripled our conversion rates, quadrupled our traffic to the site, and really gave a better user experience for the customers. Fulfilled, more orders than we ever had. We've done SBA, traditional bank lending. We've had private lenders, investors, MasterCard, Visa, advanced loans, different types of inventory financing to maintain the flow of our inventory and our cash flow for everyday needs, from payroll to rent to sales tax and whatnot. We're looking and talking to people about partnering with us to grow our .com and really become the indie Zappos. We have an idea that's scaling and growing so fast that it's something more than we can finance ourselves through a traditional bank.
Welcome, thank you for being here today. And the nature of this panel is really about startups. And by startups, we mean ground zero. So a number of you, sometimes when you get to traditional lenders, you're faced with what's your track history? Have you, where's those 2 years of financial projections? And the fact of the matter is, if you're growing and you're starting from ground zero, you still need some funding. Especially, we just heard from 2 people who were growing on a fast trajectory. They needed money to really get it going and scaling. So what we're going to do with this panel very quickly is there are a number of these people on the panel who have used equity to ramp up their business, and other ones have used debt. So we wanted to give you an overview of What are the parameters that make you ready for equity or debt in a startup situation? So I'm going to pass it over to Mark Ackler. Mark has been a VC, a serial entrepreneur, and he recently led innovation at Redbox. But give us your overview on what do you need if you really want to get equity? Why is it different than that?
So if you're interested in equity, first of all, you have to understand who you're asking for money from. So not all equity investors are the same. There are different size firms, from angel groups all the way through the very largest private equity firms that have multi-billion-dollar investments, and each one of them have a different investment thesis and philosophy. So it's really important to understand who you're talking to and what their investment thesis is. So typically, if it's an early stage venture capital firm, they have a thesis that could be sector specific. They could be interested in technology deals or medical deals or bio. And so it's really important to understand what their sector is. They could be stage specific. They could be early stage investors. They could be later stage investors. So it's really important to understand how and what their sweet spot is. And it's actually pretty easy to figure it out. If you go to the venture capital website of the particular firm, they're very clear in their website of what types of companies they're looking to invest in.
So I'm going to ask you one other question. One of the big things is that investors are looking for an exit. And what does that mean to the owner of a company?
So when you take money from a professional investor, you're taking their agenda. And their agenda is very straightforward. So they want to make a certain multiple of return over X return over Y years. Typically, they're looking for the classic, they'll say, is a 10X return. Most investors will be pretty happy with a 3 to 5X return. And they're looking for return sometime in a 5 to 10 year time frame. And you also have to understand how venture capital firms work and what cycles they are. So a venture capital cycle typically is about 7 years. And are they making the investment at the beginning of their cycle or the end of the cycle? Because that also is really important in terms of their time frame and perspective for when they want to make a return. But an exit is either the business is going to be sold or it's going to go public. That's the exit. And the venture cap, if you're taking their money, you're taking their agenda, and it's very straightforward. They want to make X return in Y years.
And as an owner, you could be part of that agenda or not. So you really have to understand, if you're trying to build a company that you want to pass on to the next generation, equity may not be a starting point to think about. But if you see yourself doing multiple companies over time, equity could be absolutely the perfect one. So I'm going to go over to Sharon Schneider, who you saw on the screen. And what was interesting to you is that you were kind of going, I could have gone organically and grown this slowly, but I really wanted to ramp up, is what you decided. So you decide to go for the equity piece. So tell us a little bit how you did it and where do you think you're going to be in 5 years?
Yeah, I think we had the good fortune to participate in a program last summer, Accelerate Labs, which kind of educated us a lot about.
Why don't you explain a little bit what an accelerator is?
An accelerator is very often like a 12-week boot camp where they take, it's competitive, they select maybe 10 companies, they give them some cash in return for a little bit of equity, but then they just pour resources on those companies, mentorship, education, networking, and at the end it usually culminates with what they call demo day, where you get up and you have 10 minutes to pitch full of a room like this that is full of 500 investors. That would be Accelerate Labs demo day. And so over the course of those 12 weeks, you have to make quite a lot of progress, and you do. You sort of figure out which way your business needs to go. We ended up making a pretty large pivot, which you heard about in the video. And so after demo day, we had 6 weeks of track record. So it's not very much track record. But what we also had was we had begun relationships with these mentors, investors, advisors who saw our track record as entrepreneurs and as a team. So it wasn't that we had this many months of sales, but they saw how we handled adversity. They saw how we dealt with challenges and roadblocks and overcame them to make the business better and stronger and flourish. And I think in those early days, those investors that we did a convertible note, they were investing in our team much more than in the business model as it was at that time. So that's going to change. They always say, I bet on the jockey, not on the horse. And I think that was really what we benefited from.
And where are you in your fundraising right now?
So we closed a convertible note last fall. That was sort of a bridge, to help us implement our new model, which was the resale, again, rather than sort of the Netflix kind of model where we owned it, but we just now sell it. So we raised that, but we're not cash flow positive. I mean, every month, that investor dollars is dwindling. So we're in the process of raising a priced round at the moment. So actually, we've been here today talking to how are we going to make those funds last until we can close a priced round, and do we need some kind of line of credit? Do we need some kind of short-term loan to help us get to until that equity round closes?
So I have to tell you, in the green room, she's already talking to Jonathan about that loan. So hopefully we'll have a deal tomorrow, right, between the two of you. That'd be excellent. Okay, let's go down to Paul Fehrenbacher. Very different type of business, medical device. If you went to a traditional banker, they may go, what? So tell us a little bit about your medical device and how you've been able to keep yourself going as you build the business.
Sure. So the company Brightseed, our technology is called SafeSnips. It was born out of an innovative program Northwestern has called New Invention Medical Innovation, where graduate students come together and identify an unmet clinical need and solve it, patent it, and then eventually every few years a company is formed out of it. We're fortunate to be one of the companies. And what our device does, it detects the presence of blood vessels in real time. So we'll integrate with existing surgical tools, so before a surgeon makes a surgical cut, they'll be identified the presence, size, some other metrics of the blood vessel. Now, medical device sector is challenging. I wouldn't be able to get investment dollars at this time last year, so what we had to do when it was business plan competitions. We did 3 business plan competitions, raised over $100,000 in cash and in-kind services, so we could hit metrics that investors wanted to see, such as our prototype functioning at the bench level, figuring out what our FDA regulatory pathway would be, getting a reimbursement strategy, some other inherent challenges in the medical device sector, and then we were able to actually approach some individual